And our second session is about financial accounting, which is important domain knowledge that will be used as a fundament for the next sessions. Let's explore it together. In this session, we will cover the following: understanding what accounting is, why it's needed, and what type of accountings we have. Next, we will learn about debit and credit concepts and how they use in accounting transactions called journal entries. Then there come topics such as general ledger, GL accounts, and chart of accounts. We will learn about trial balance and its role in financial statements preparation, such as balance sheet, profit and loss, which is also called income statement, and cash flow. As well as we will learn about CapEx and OpEx and what are the cash and accrual methods and what they used for. Then we will explore how three financial statements are connected and how to use these for identifying errors, concluding with a look at some of the frequently used ratios that we can use in our financial analysis. Accounting is the systematic process of recording, analyzing, and reporting financial transactions and information. Its primary objective is to assist organizations in effectively managing their finances. Now, let's break down the key points further. One of the primary purposes of accounting is to provide accurate and reliable financial information. This information is crucial for both internal and external stakeholders, such as management, investors, and creditors. They rely on this data to make informed decisions about the financial health of a company. By maintaining proper systematic accounting records, which means transactions are posted and documented by systematic manner, business can track their income, expenses, assets, and liabilities, ensuring financial transparency and accountability. Systematic here means accounting rules, standards, and so on. We will talk about some of them in more details in this session. This way of record keeping ensures transparency and accountability in financial matters. In simpler terms, it helps us understand where money is coming from, where it's going, what assets we possess, and what obligations we owe. Moreover, accounting is not just about numbers. It's a critical tool for making informed business decisions. Whether it's assessing the financial performance of a company, ensuring compliance with regulatory requirements, or attracting potential investors and creditors, accounting plays a vital role in all these aspects. And in order to make decisions, we need reports and financial statements, which is reporting part of accounting, where reports are created not only for investors, financial institutions, and internal management, but also for government and audit, where different reports are submitted there for compliance, tax, and different reasons. Before we go further with types of accounting, let's briefly talk about difference between finance and accounting. So we mentioned that accounting is more focused on recording, reporting, and analysis of day-to-day transactions. But finance is more broader term and mainly focused on managing of cash and other assets, liabilities, and planning the future of the company.
It's
Which
also
plays a
often
huge
said
role
that
in
accounting is
control
more
of
focused on
strategy of the
historical
company.
and current information, whereas finance is more forward-focusing to forecast and plan future. Now that we have covered the terminology, let's return back to the specifics of accounting. In accounting, there are several distinct areas, each serving specific purposes and different stakeholders. Let's break them down one by one. So firstly, we have bookkeeping. This involves the recording of financial transactions and maintaining financial records. Essentially, it's the foundation of the accounting process, ensuring that every financial movement is accurately documented. Next is financial accounting. This type of accounting is for providing financial information to external stakeholders. These external parties including investors, creditors, and regulatory bodies. They rely on this information to assess the company's financial health and make important decisions. Moving on, we have managerial accounting or management accounting. Unlike financial accounting, this branch is all about serving internal stakeholders, primarily management. Here, accountants provide crucial information to management for decision making, strategic planning, and day-to-day control of operations within the organization. It's the essential information for managers to manage their organization effectively. Lastly, we come to tax accounting. Tax accountants specialize in navigating in complex tax landscape. Their focus is on ensuring compliance with tax regulations and preparing tax documents for various entities, including government, tax authorities, organizations, and individuals. Please note, in this course, we will mainly touch topics related to financial accounting, and occasionally we might cover some areas of bookkeeping and management accounting. Let's briefly discuss the exciting data opportunities in the field of accounting. This innovative intersection of technology and finance opens new directions for efficiency and accuracy. Let's delve into some examples. One significant area where data experts are making a mark is in process improvement. By developing algorithms and tools, accounting process get streamlined, reducing manual effort and minimizing errors. For instance, automation of some tasks such as invoice processing and matching with payments, implementation of real-time expense tracking system, and so on. In audit and compliance, auditors and accountants can conduct thorough financial health check using machine learning models and identify non-compliance issues swiftly. For example, animal detection algorithms are employed to flag potentially abnormal or fraudulent transactions, ensuring financial integrity. Data science has revolutionized also financial planning and forecasting process. Using predictive modeling and simulation models, now accountants can create accurate financial forecasts of their cash, revenue, and simulate situations supporting strategic planning initiatives. Debit and credit, often abbreviated as debit DR and credit as CR, are foundational terms in the language of accounting. They serve as a backbone for recording financial transactions accurately. At its core, debit and credit represent the flow of money in and out of accounts.
These terms act as a language accountants use to describe the movement of funds within the organization's financial system. One essential principle to remember is that every accounting transaction must have an equal debit and credit amount. This principle, known as the double entry accounting system, ensures the balance and accuracy of financial records. In this scenario, we will explore the concept of debit and credit by examining a common situation: receiving payment from a customer for an invoice that our company issued. Let's break it down. Okay, when you receive payment from a customer, it's considered a debit to the bank account with positive sign. This means the money you receive increased your bank account balance. On the other side of the transaction, we have a credit with minus sign to accounts receivable for the customer. This credit reduces the accounts receivable balance because the customer is paying off their debt, so the customer's debt should decrease. Alternatively, when the customer invoice was initially recorded, it was debit plus sign to reflect the debt owed. What's crucial to understand is that even though debit and credits have different signs, they are always equal comparing their absolute values. However, it's important to note that when we refer to increase or decrease, not all components of balance sheet and profit and loss follow the same pattern. For instance, liabilities and revenue components increase with a credit side and decrease with debit. We will discuss the specifics of balance sheet and PLN components in more detail in next slides. Also remember that there is no debit without credit and vice versa. If you have debit amount not offset in your data with credit, then something wrong happened. In last slide, I removed plus and minus signs because I don't want you to associate increase or decrease in accounting with these signs. Increase or decrease should be associated with debit and credit, and depending on nature of account, you should understand which one is an increase and which one is decrease. Journal entry is an accounting transaction posted in either the general ledger or subledger accounts. Subledger accounts, also called sometimes sub-GL. Journal entry can be automated, semi-automated, or manual. Manual journals require human intervention, and they are considered as a high-risk area within the field of financial accounting. This increased risk is primarily due to the interventions involving direct entries into general ledgers, potentially impacting the financial statements of entities. Double entry is a foundational principle in accounting. It forms the logic upon which all financial transactions are recorded and understood. This principle follows the concept that every transaction has two opposite effects. debit, and credit. These effects are not only opposite but also equal, meaning that debit amount always equals the credit amount. In practical terms, each transaction affects at least two accounts. One account is debited and another is credited. This dual impact ensures that the accounting equations stay in balance. To demonstrate the impact of double entry on our accounts, let's take a look at the trial balance. Although we haven't learned the details of it yet, don't worry about that. For this particular example, we are simply using it to show how journal entries affect account balances. In the image on the left, you can see the trial balance just before we recorded the transaction. On the right side, you notice that our bank account has decreased for 500, which also changed the total debit balance in trial balance as a result of posting. Also, the trade creditor account increased by the same amount but with an opposite sign. Despite of change that of balances in accounts, we still see that total debit of all accounts is equal to total credit but with opposite sign. This balance happened because our transaction followed double entry principle. This is the short description of why we use double entry in accounting. Now that we have covered debit and credit sign, journal entries, and the double entry principle, let's test our understanding quickly. Take a look at these journal entries, take a moment to think, and let's identify which transactions might be potentially incorrect. Feel free to pause the video until you are ready to respond. Hopefully that wasn't too challenging. Now let's quickly discuss each option. In the first journal, everything appears to be in order. Debits and credits balance each other out. The next document is not correct because there is no credit line indicating that the double entry principle was not followed. In a third example, both debit and credit entries exist, but the amounts don't match. Therefore, it's not correct either. On our next document, there are two debit and one credit lines, which is fine as long as the values match. Here, the total debit and credit values matching, indicating that the entry is correct. But what about the last option? Here debit and credit lines balance, but the account is repeating. Can we consider it as a correct journal? Well, the answer is depends. This transaction might be considered a correct posting if it was intentionally done to the same account for adjustment purposes. This type of transaction is called reclass in accounting. For instance, imagine a scenario where an account balance contains incorrectly posted transactions with the wrong profit center. You might not be familiar with profit centers yet, but we will discuss them in SAP Transactions data session. Briefly, profit centers can reflect the revenue of various products. For example, let's say you want to track the sales revenue for different fruits like apples and orange separately. You would post all revenue transactions to the same revenue account but assign different profit centers for each fruit, like profit center A for apples and profit center B for oranges, to have a clear breakdown of the revenue per products. Returning to our example, in this particular case, if we consider more details and in this situation profit center parameters of each line, we can say that there is no issue with this particular posting from double entry wise because the end user posted the transaction to the account with a different profit center. Yes, there is no effect of the posting on total balance of account, but there is reclass, so breakdown of this account will be different. This transaction here is correct technically, unless there is no other issues that we don't know about, such as calculation and so on. Okay, so we know these transactions, are also called journal entries, are posted to either general ledger or subledger accounts, which are both components of the general ledger system. Think of the general ledger as a central repository that keeps track of all financial transactions within an organization. A general ledger account, often referred to as a GL account, offers one of the options for recording your transaction. When we talk about the transaction being recorded in account, think of it as capturing a single leg of the transaction, or in simple terms, a line in a journal entry. For example, you can see on top right side an example of journal where one side of the journal, the debit side, can be allocated to one GL while the other side, the credit side, may be assigned to a different account. A similar approach applies to subledger accounts. GL accounts are highly specific and can store lines of journal entries that relate to the nature of that particular GL account. In the following visual example, you can observe various GL accounts along with the display of how these GL accounts are organized within the general ledger. Additionally, we also have subledger accounts, sometimes referred to as sub-GL accounts, where you can also record individual lines of journal entries. However, subledger accounts contain exceptionally detailed or granular data. For instance, typically we might gather all customer accounts which are considered subledger accounts and place them under the umbrella of trade debtors GL account. This arrangement restricts direct posting to GL account because doing so would not provide a detailed breakdown of which customer each specific invoice pertains to. Therefore, the only way to record transactions like customer invoice, payments, credit notes, and so on in the trade debtors category is by posting them within the individual customer accounts to which these transactions are related to. As a result, all customer account balances are summarized and reconciled on the GL account to which they are linked. These GL accounts, where all subledger accounts are mapped, are known as GL reconciliation accounts, and typically you cannot post directly to them as we mentioned earlier. By leveraging subledger accounts, you gain a more accurate view of your financial transaction, enhancing your ability to analyze and reconcile postings. In the picture below, you can see an illustrative example of how this arrangement works for both customer subledger accounts and supplier accounts. The chart of accounts serves as a structured template that includes all GL accounts from both balance sheet and profit and loss, along with their corresponding parameters and descriptions. This comprehensive list of accounts is built up for the unique needs and operations of an organization or entities. In another word, the chart of account is a standardized structure for organizing and classifying financial transactions. The chart of accounts is not a one-size-fits-all solution. Rather, it's tailored to the specific standards, policies, and processes followed by a particular organization, entity, and country. It reflects the unique financial needs and nuances of that entity, allowing for effective management and reporting of financial information. From a technical standpoint, particularly in SAP Finance module, you are required to link every company code to a chart of accounts to establish the structure of general ledger accounts specific to that entity or company. It's essential to ensure that this aligns with your company's accounting policies and standards. Remember, technically, companies don't have to use all GL accounts existing in chart of account. You only extend those accounts that are needed for your company code. However, all GL accounts with proper descriptions and details must be in chart of accounts if those accounts are required for this company code. For instance, in the illustration provided, we have two chart of accounts. First is UK chart of account and second one is for Germany. First one is used for structuring GL accounts of UK's 01 company code, which is for entity in UK. And second one is for Germany-based branch of Fruticorp, which is represented with company code GER1 here. But what happens when a new branch is established, say in France and United States? How do we determine whether we can utilize existing chart of accounts for new company codes or if we need to create new country specific ones? This question is typically answered by our experts who have a deep understanding of the accounting process, policies, and standards used for new and existing company codes. They assess the types of GL accounts required, as well as the necessary account descriptions and additional details. After careful analysis and comparison of these parameters, if a suitable chart of account already exists, the new company code can be assigned to it. Otherwise, a new one must be created to align with the specific requirements of that company. In the given scenario, the France-based company shared many similarities with the accounting process and standards of Germany-based unit. As a result, the decision was made to utilize DEC1 chart of account for France, which was originally created for Germany. Of course, it's such an example. In reality, it might not work. Conversely, for US unit, the requirements may be distinct, possibly due to US accounting standards called US GAAP, which can differ from the IFRS standard followed by most European countries. In this case, a new chart of accounts must be created and the company code USA1 should be assigned to it. To summarize, understanding of the chart of accounts can be valuable for data professionals seeking to identify similarities between the general ledger structures of two or more company codes. This understanding can greatly enhance tasks like feature engineering and pattern recognition. The trial balance is a crucial step in the accounting process, and its primary purpose is to ensure the accuracy of financial records. Trial balance is used to verify that the total debit and credit in general ledger accounts are in balance. In other words, it's like a checkpoint ensuring that the books are in order. By comparing the total debits with the total credit line, we can identify any potential accounting errors that might have occurred during the recording of financial transactions. When the trial balance successfully balances, we can utilize the result of trial balance to prepare specific financial statements.
In summary, the trial balance is more than just a balancing act. It's a critical checkpoint in accounting. It ensures accuracy and integrity in financial records and serves as a foundation for preparing essential financial statements.
Okay, so how it happens? First, you need to take all journal entries from general ledger. Summarize data and pass it to trial balance. As we mentioned, trial balance is a critical checkpoint where we match debit and credit balance as well as check for other potential errors. Once it's passed through the check, we are now ready to create financial statements. There are three mainly used financial statements, and we will cover all of them in next episodes. Briefly, first is balance sheet statement, which is the snapshot of financial situation of business at the moment of time, so it doesn't cover a time frame. Next one is profit and loss statement, also called income statement, which is the summary of business revenue, cost, and expense transactions during a specified time frame. It can be days, month, quarter, or year. And third one among this trio is cash flow statement, which is overview of all cash inputs and outputs, also in a specified time frame. A balance sheet is a financial statement that presents a company's financial position by reporting assets, liabilities, and shareholder equity. It serves as a snapshot of finance of the company, detailing what it owns and what it owes as of the statement's publication date. The balance sheet is one of the three key financial statements used for evaluating a business. Structurally, a balance sheet consists of three primary sections. On the left side, you have the assets. On the right side, the liability and shareholders' equity. Assets contain everything that the business owns or has control over, and these assets hold economic value. Liabilities, on the other hand, pertain to the debts and obligations that the business owes to external parties. Shareholders' equity represent the portion of the business owned by its shareholders, reflecting the amount owed to the owners. Additionally, both assets and liabilities can be categorized as either current or non-current, depending on their liquidity and expected duration. It's important to remember that the total balance of assets must always equal the sum of liabilities and shareholders' equities with opposite sign. In other words, the debit balance on the left side should match the credit balance on the right side. The term balance sheet underscores the importance of this balance. With the left and right balances offsetting each other with the opposite sign, we can say that assets increase when recorded with the debit sign and decrease when recorded with the credit sign. Conversely, liabilities and shareholders' equity follow the opposite pattern, where an increase is indicated by credit and decrease by debit signs. Now, let's take a closer look at each of these elements. Assets in accounting terms refer to current economic resources capable of generating a positive economic value or benefit. Assets can be either current or non-current. Current assets contain resources that are anticipated to be converted into cash latest within a year. Examples include cash on hand, accounts receivable, money owed by customer, and inventory. Non-current assets, in contrast, are resources with longer-term value and are not expected to be converted into cash within a year. These assets include property, equipment, intangible assets like patents or copyrights, and long-term investments in other entities. Also, assets can be either tangible or intangible. Intangible assets are non-monetary assets that lack a physical presence and cannot be seen or touched. Examples of intangible assets are trademarks, patents, and software. Tangible assets, on the other side, are physical assets that have a physical form and can be seen, touched, and felt. Examples include inventory, equipment, buildings, money or cash, and accounts receivable. Here are some components of assets section. Let's begin with current assets. These are assets that are expected to be converted into cash or used up within a short period, typically a year or less. Current assets play a pivotal role in a company's day-to-day operations. Cash. Cash represents the most liquid form of assets. It includes physical currency and bank deposits. Cash provides the company with immediate access to funds for daily operations, investments, and meeting financial obligations. Accounts receivable or AR represent amounts owed to the company by its customers for goods sold or service provided on credit. It signifies the company's right to receive payment in the future. AR is a vital component as it directly impacts the company's cash flow and liquidity. Prepaid expenses are costs that have been paid in advance but have not yet been incurred. These expenses represent future financial outflows that the company has prepared. Examples include prepaid insurance premiums, prepaid rent, or prepaid subscriptions. Over time, as the benefits associated with these prepared expenses are consumed or utilized, they are gradually recognized as expenses in profit and loss statement. Inventory refers to the goods and materials or products that a company holds for sale, production, or future use in its operation. It represents one of the key assets for business involved in manufacturing, retail, or any industry where physical goods are bought, produced, and sold. When it comes to non-current assets, these assets that are not expected to be converted into cash or used up within a year. They typically have a longer-term nature and are essential for the ongoing operations of business. Property, plant, and equipment, or PP&E, refers to the long-term tangible assets used in the production or operation of a business. This category includes land, buildings, machinery, vehicles, furniture, and fixtures. These assets are not easily converted into cash and are typically held for an extended period to support business operations. Goodwill represents the intangible value of a company's reputation, brand, customer relationship, and other non-physical assets. It often arises when one company acquires another for a price greater than the net value of its identifiable tangible or intangible assets. Goodwill reflects the potential for future earnings and synergy resulting from the acquisition.
It's important to note that although we have covered most used key components of both current and non-current assets,
there may be other items as well.
Liabilities, as defined in accounting, are obligations or debts that a company owes to external parties resulting from previous transactions or events.
Similar to assets, liabilities also can be current or non-current. Current liabilities contain obligations anticipated to be settled in the near term, typically within a year. Examples include accounts payable, money owed to suppliers, and short-term loans. Non-current liabilities consist of obligations not scheduled for repayment within the upcoming year. Examples include long-term loans and bonds payable.
Let's see what are the components that make up the liability section of the balance sheet, which is crucial for understanding an organization's financial obligations and commitments.
Let's begin with the current liabilities. These are obligations that the company expected to settle within a year. Accounts payable represent amounts owed by the company to its supplier or vendors for goods or services purchased on credit. It's a reflection of companies' outstanding bills that need to be paid. Accounts payable have a direct impact on the company's cash flow and working capital management. Accrued expenses are costs that have been incurred but have not yet been paid. These can include expenses like salaries and wages, interest, tax, and utilities. Accrued expenses represent financial obligations that the company needs to settle in the near future and significantly affect its financial position.
Unearned revenue represent payments received from customers for goods or services that have not yet been delivered or earned by the company.
It's a liability on the company's balance because the company has an obligation to provide the goods or services in the future. Unearned revenue reflects the company's commitment to fulfilling its promises to customers.
Now let's move on to non-current liabilities. These are long-term financial obligations that extend beyond 1 year.
Long-term debt represent borrowing or financial obligations that have a duration extending beyond 1 year. This category includes bonds, bank loans, and other long-term financing arrangements. Long-term debt is an essential aspect of a company's capital structure and financial leverage, impacting its long-term financial stability and strategy. It's essential to note that while we covered some of the most common components of both current and non-current liabilities, there may be other items specific to your organization or industry that are not included in this example.
Shareholders' equity represents the residual interest in assets of a company after subtracting its liabilities. In simpler words, it reflects the owner's claims on the company's resources. Let's break down the components that contribute to shareholders' equity. First, we have share capital. This represents the value of funds that shareholders have invested in the company. When a company is initially formed, shareholders typically invest cash. For instance, imagine an investor starts a company and seeds it with 10 million USD. In this case, as a result, the company cash account arises by 10 million because business received that money in bank account and share capital also increased by 10 million. In this case, both assets and shareholders' equity increase for 10 million, balancing out each other. Moving on, we have retained earnings, which signifies the total amount of net income that the company chooses to retain. Lastly, we have dividend payments. This represents the portion of company's net income
that is distributed to its shareholders as dividends. Dividends are payments made to the owners or shareholders of a company's stock as a return on their investment. When dividends are paid, they reduce or offset the balance of returned earning account, reflecting the distribution of profits to shareholders. In essence, shareholders' equity embodies the financial relationship between the owners of the company and the resources it possesses.
In this section, we'll explore the profit and loss statement, often referred to as the income statement. This statement plays a crucial role in financial reporting. The primary purpose of the profit and loss statement, or PLN for short, is to reflect the financial performance of a business during the specific period. It does so by showing the net income or loss that results from subtracting the total cost and expenses from the revenue generated during the same period. In other words, it answers the question, did the company make a profit or incur a loss during the period under review? Understanding the components of revenue, costs, expenses, and how they interact in the PLN statement is essential for informed decision-making, financial planning, and evaluating the overall health of the company. PLN statements are typically generated on a regular basis, and the frequency can vary. Companies often prepare these statements on a monthly, quarterly, or annual basis, depending on their internal reporting needs and external regulatory requirements. The choice of reporting frequency depends also on the company's size, industry, and accounting practices. It's worth noting that in this statement only includes transactions that occurred during the specific period it covers. This means that expenses are recognized when they are incurred, not necessarily when the actual monetary transaction takes place. When we say monetary transaction, we usually mean incoming and outgoing payments. We'll look into this concept in greater detail when we discuss the cash flow statement and compare these two statements. Let's see what we have in this PLN statement. It's essential to recognize that the structure can vary depending on the type of business and its specific requirements. But let's begin with the fundamental elements commonly found in PLN statement. At the very top of the statement, we have revenue. This represents the total amount of money generated from the sale of goods or services by the company. It's a pivotal indicator of the company's ability to generate income and foster business growth. Directly below revenue, we find cost of goods sold, often abbreviated as COGS. This figure contains all the costs and expenses directly related to the production of goods. Subtracting COGS from revenue gives us the gross profit, which serves as an indicator of the profitability of the company's core operations before factoring in other operating expenses. Moving down, we come to operating expenses, shortly called OpEx. These include all costs incurred in the day-to-day operations of the business and not directly tied to the production of goods or services. These expenses can encompass rent, salaries, utilities, marketing expense, and administrative costs. By subtracting the total operating expenses from the gross profit, we arrive at operating income or operating profit. This figure reflects the profitability of the company's core operations after considering all operating expenses. It's a significant figure because it tells us how much money the company made or lost from its primary business activities. Then we encounter other income and other expenses. This represents non-operating income and expense items that are not directly related to the company's core operations. Other income can include gains from the sales of assets or interest income, while other expenses can consist of losses from the sales of assets or interest expenses. These two usually are more related to investment activities and decisions rather than operating. Next in line we have taxes. This represents the company's tax obligations based on its taxable income. This includes income taxes payable to the appropriate tax authorities. At the bottom of the statement, we find net income or net loss. This component is the final one and calculated by subtracting other income and other expenses and taxes from operating income. It represents the company's overall profitability after considering all revenues, costs, and expenses. As I mentioned earlier, this is the standard structure for a profit and loss statement. It might not fit every company's needs. Depending on the various factors such as accounting regulations and specific nature of business, the structure can differ. For instance, depreciation is typically included in operating expenses or in OpEx, but in some cases it may be shown separately after OpEx. Furthermore, it can even be added into COGS if it's calculated based on cost of the units method, which is not the topic of this course. In this financial landscape, it's important to note that all income items are reflected as credit amounts. This means they grow with credit sign and decrease with the debit sign. It's rare they get decreased, but one of the examples where it might happen is reversing revenue transaction. Conversely, expenditures increase with the debit sign and decrease with credit sign. This is a fundamental financial principle. To make this clearer, I've added symbolic values to each element of the PLN statement. Let's take a closer look. For example, we see that the total revenue or sales amount is $64,000 and it's recorded as a credit because it signifies income. On the other side, the cost of goods, which is an expense, stands at 40K and it's shown as a debit positive value. This same principle applies to other income elements such as operating income as well as expenditures like other expenses and tax payments. And at the end of the journey, we arrive at our net value, which is the credit value of 15K, indicating a negative amount. In other words, it's a net income. But if it would be with debit sign, which is positive amount, then it would be a net loss. This was our short explanation of what is PLN statement, its structure, and how it's working. In the world of finance and accounting, you will often come across two important terms, OpEx and CapEx. These terms are essential to understand if you are working with financial data and finance experts. So let's talk about what they mean. You need to remember that OpEx is a term used in two different contexts in finance. The first context is within the PLN statement, also known as income statement. This part of PLN, called operating expense, which you can see on your screen, includes expenses such as rent, salaries, utilities, and more. In essence, it encompasses everything related to day-to-day operational costs and not related to production costs. Since we are already familiar with this aspect, we will not focus on it further. The second context where you will encounter OpEx is related to fixed assets or PP&E. In this context, OpEx signifies the ongoing spending required to keep your fixed assets running smoothly. Think of expenses like vehicle maintenance or service charges, building cleaning, or even software-related cloud expense. On the other side, also in the topic of PP&E and fixed asset, there is the CapEx. CapEx, which stands for capital expenditures, represent the money a company spends to either acquire new fixed assets or upgrade existing ones. These assets can range from buildings and vehicles to software and beyond. In essence, it's investment made to expand or enhance the company's asset base. Usually when you see the terms CapEx and OpEx used together, it's usually in the context of fixed assets and PP&E, where CapEx signifies the initial investment, while OpEx covers the ongoing cost to maintain those assets. Okay, now let's have a quick overview on how CapEx and OpEx related transactions impact statements and GL accounts. There are different types of transactions might be associated with CapEx and OpEx depending on your system and accounting policies. But there are few things that you need to know in order to understand all of them. CapEx transactions usually do not impact PLN, so you cannot find them in PLN accounts. But by time after using them, they will appear there through depreciation and will sit in depreciation expenditure accounts, but only by time. They usually reflected in PP&E accounts in asset part of your balance sheet. Since they are purchased using bank accounts, you can also find transactions related to CapEx in your bank accounts in balance sheet, and consequently in cash flow statement as well. Since we are not going into depths in PP&E and fixed asset topics, I can only briefly mention that depreciation is like spreading the cost of an asset, like a vehicle or building, over its useful lifetime. Instead of recording the entire cost all at once in PLN, you divide it into smaller amounts over time. It's a way to reflect the real impact of the asset on your finances over its lifespan. In contrast, OpEx costs related to the maintenance of PP&E assets do touch the PLN accounts. They usually sit in the operating expense section of the PLN statement. Just like CapEx, OpEx costs are also paid and impact the bank accounts within the asset section of balance sheet. And these cash movements are also represented in cash flow statement. Understanding the distinctions between CapEx and OpEx and how they interact with financial statements can significantly enhance your understanding of accounting data and process. Consequently, this might impact positively your effective financial analysis and feature engineering skills. Before we dive into the details of cash flow statement, let's get a handle on the difference between cash and accrual methods in accounting. These are two primary methods of doing accounting, and the key distinction is around when we recognize revenue and expenses, or in other words, difference is in timing. Now let's break it down. Accrual method allows us to recognize receivables as revenue and payables as expenses if they are related to the reporting period. Here is the simple way to understand it. If your company sold goods during the reporting period, you record it as revenue, even if the customer hasn't paid you yet. Similarly, if you receive a vendor invoice for something like rent for the current month, it's considered an expense for this period, even if the actual payment happens later in the next period or maybe even several periods down the line. In essence, with the accrual method, we recognize revenue when they earned and expenses when they incurred, regardless of the actual money flow, like incoming and outgoing payments. Now let's take a look at the cash method. This method operates differently from accrual method. With the cash method, we recognize revenue or expenses only when we actually receive or make payments. In the examples I mentioned earlier, you would have to wait for the cash payments to come in or go out before recognizing revenue or expenses. In simple terms, under the cash method, revenue and expenses are recognized when the actual cash is received or paid out. Let's compare the cash method and the accrual method. The accrual method is helpful when you want to assess long-term profitability because it better reflects the economic reality of a business. For instance, although it might seem like there is no cash inflow for the current period at first glance, examining multiple periods might give us a different picture, for example, showing that there are material incoming payments expected from customers in next months. On the other hand, the cash method is useful for controlling liquidity because it's a better method for tracking cash flow. As an example, let's say a company performs well in the long term, however, it might face short-term liquidity issues due to insufficient cash to cover immediate expenses. It might be due to ineffective liquidity control using cash method. In short, the accrual method provides insight into long-term profitability, while the cash method is crucial for monitoring short-term liquidity. Using only the cash method might not be allowed for companies following international finance and accounting standards, such as IFRS. Hence, most companies use the accrual method for their income statement and separately prepare the cash flow statement using cash method. However, if you would use the cash method for your income statement, PLN preparation, which might be quite interesting and maybe even strange, the result would closely resemble that of the cash flow statement. Now you know the difference between cash and accrued method in accounting. Alright, now that we have grasped the fundamental difference between the accrual and cash methods, and we understand the purpose of PLN and cash flow, let's briefly go into the details of cash flow statement. So, what's the cash flow statement? It's like a financial snapshot, showcasing how cash moves in and out of the company. The cash flow statement provides us with a clear picture of business cash inflows and outflows during a specific period. It might be a month, quarter, year, or any specific range of dates. On your screen, you can see an example of simplified cash flow statement. Here we have cash flow prepared for 2014, 15, and 16. Now let's talk about main components of cash flow statement. First component here is cash flow from operating activities. This section focuses on cash movements that originate from a company's everyday operations. It sums up the net cash flow generated by these activities. For example, it includes cash received from selling goods or services to customer and cash paid to suppliers and employees. Net income, which is the final value generated from PLN statement, is the starting point in calculating cash flow in this section. Next is the cash flow from investing activities. In this part, we reflect cash movements related to the purchase or sale of property, plants, and equipment, shortly called PP&E, and long-term investments. Essentially, it helps us understand the company's investments and divestments. And last one is cash flow from financing activities. Here you will find details about changes in cash associated with activities like buying back company's own stock, issuing bonds, and making payments for interest and dividends to shareholders. The final figures as a result of these three activities are reflected in net cash flow. Here are all the parts of cash flow. We'll not go into the details of each, but we continue our general discussion about cash flow in our next topic called three statements connection. So we have discussed three essential financial statements: the balance sheet, profit and loss, and cash flow statements, and each serving its unique purpose. But what's interesting is that there is a significant connection between all three of them. These connections provide us with a powerful tool, and you can use this feature for cross-checking the statements or finding errors in data. These connections exist because these statements are prepared using the same financial data, and elements from each of these statements can be used interchangeably. We will not dive into all the connections, but we will cover only fundamental and vivid ones, so being as a non-finance professional, you could easily digest that information. The first thing you can assess in balance sheet, even without referencing to the PLN or cash flow, is whether it balanced correctly. This involves checking if the total assets align with the total combined liabilities and shareholders' equity. Usually, last transaction before closing period is to move PLN results to returned earnings account in equity part. This transaction means completion of the accounting period, and after this, assets should be equal to the sum of liabilities and equity. In this case, as shown, when the value is matching, it indicates that there is no imbalance between the different components, which is good, and period is completed. Another important point to understand is that the final result of the PLN statement typically doesn't directly matching with the cash account. Whether it's a net income or net loss doesn't matter. This is the common misconception, especially among beginners, who might assume that if a company earns money, it should directly reflect in its bank account, also known as a cash account. However, in reality, this is not the case, and if you think that the difference might be due to the accrual method used in the PLN statement, you are correct. As we already know, the accrual method accounts for revenues and expenses when they are incurred, not necessarily when the cash transaction occurs. The PLN result is transferred to the balance sheet through an account known as returned earnings. At the end of each period, it's carried over and displayed as an accrued earning for that specific period. You can observe on your screen how this is calculated. It involves the previous closing balance of returned earning account combined with the current period's net income taken from the PLN statement. Furthermore, net income serves as an initial point for calculating cash flow, as you may recall from the previous topics. It's only when we arrive at the net cash flow that we should expect to find an impact on our cash balance or bank account. On your screen, you can see how this is cross-checked by adding the previous month's closing balance in the cash account to the net cash flow for the current period. You should arrive at the closing balance for the current period. Please note that we highlighted and explained only connections that are relatively straightforward and easy to understand for data professionals with no finance background. But you should note that there are much more connections, and here are some examples, just for your awareness. As we come to the end of this topic, I have a practice task for you. Given the previous discussed connections between the three financial statements, take a moment and calculate the missing figures in balance sheet report. Feel free to pause the video for a few minutes to calculate them. Hopefully it was not very difficult for you. Let's see the answers. First, we can easily find returned earnings result for 2018 by just summing 2017 returning earnings closing balance and net income for 2018. After that, we can easily calculate total shareholders' equity for 2018. And then total liabilities and total shareholders' equities together. This is simple arithmetic, and you just need to sum up all these figures. The result of total liabilities and total shareholders' equity together should be equal to total assets for 2018. Since we have now total assets amount, we can calculate components of it. We know that total asset is equal to sum of current and non-current assets. From non-current assets, we have here PP&E and goodwill, so we can deduct it from total assets in order to get total current assets figure. And then calculate remaining part of the current assets, which is AR, accounts receivable. Next, we can do the same calculation for 2019 to calculate returned earnings. And then total equity and liabilities. And then total assets. And finally, property and equipment part, or PP&E. Here is the second practice task. Find any issues, errors with these statements shown on your screen. Feel free to pause the video for a few minutes to analyze them. Great! I hope you were able to identify these errors. Here are the answers. In the balance sheet report for the 2014 period, the sum of assets doesn't balance with the sum of liabilities and owner's equity. It's first issue. There is an error in the returned earnings balance for 2016. It doesn't align with the expectations. Here is a calculation and number that needs to be there instead. The cash account balance for the same year is not accurately reflected. Either the cash account balance or the net cash flow figures appear to be incorrect. At the end, it's important to reiterate that there are many more connections and complexities among these three statements, so keep learning and analyzing. With time and experience, you will become more adept at spotting anomalies and errors in your financial data. Our next topic is financial ratios. In my opinion, knowing financial ratios is crucial for anyone working in the finance field and doing such data projects as an anomaly detection, forecasting, or even BI projects. These ratios use numerical data extracted from financial statements to gain valuable insights into a company's performance and financial health. By examining figures from the balance sheet, profit and loss, and cash flow statements, we can conduct quantitative assessment focusing on various indicators such as liquidity, growth, profit margins, profitability, rates of return, valuation, and more. Analyzing financial ratios are usually done for two purposes. First, to monitor the performance of an individual company, which is vital for managers as it helps them to identify negative trends over time and do strategic decisions. For instance, they can detect if the company's profitability is declining or not. And second one, to make comparative assessment of the performance of two or more companies. This is crucial for investors who want to determine which company is the most efficient or offers better investment potential. Now let's take a look at some examples of financial ratios derived from the balance sheet and profit and loss statements. We will focus on three categories here: liquidity ratios, leverage financial ratios, and profitability ratios. Current ratio, or also called working capital ratio, together with asset test ratio, are used for liquidity assessment of business. For example, the current ratio measures the capability of business to meet its short-term obligations that are due within a year. It's calculated by simply dividing current assets to current liabilities. Asset test ratio, which is also called quick ratio, measures how sufficient a company's short-term assets to cover its current liabilities. We also have leverage financial ratios used to measure dependency of companies' operations from debt from financial institutions, which is the good metric to understand a company's capital structure. For example, debt ratio is one of the easiest examples, which is calculated by dividing total financial debt that company has to total assets. Profitability ratio, on the other side, used to measure profitability of business. Some of examples are gross margin, operating profit margin, return on assets, and so on. For more information and resources on financial ratios and other financial topics, you can visit the source page of corporatefinanceinstitute.com. It's a valuable starting point for expanding your knowledge in the field of finance. And last one, return on assets of 8% in average, which means for every $1 of assets invested, the company generates 8 cents in net profit annually. This ratio reveals the efficiency of assets utilization. The interpretation part of financial ratios is not always straightforward and always requires holistic approach and significant experience. Let's take a look at some simple examples. Current ratio, or also called working capital ratio, average per 3 years is 6.5. To calculate it, you divide the total balance of current assets by total current liabilities, which we already know. This means the company can easily cover each dollar of its loans or accounts payable 6.5 times over. Generally, a ratio above 1.5 is good. However, current ratio above 3 might be some warning signal. For example, here might be the case that cash is not properly used or not well invested for short term. If there would be a significant AR balance, which is not high, current ratio might be also indicator, for example, of collection issues or others. Also, in some companies, due to business specificity, they need to keep huge amount of inventory. In such cases, the current ratio also might show high, and we need to use asset test ratio for this. Asset test ratio average of 4 or 5. This indicates the company's ability to meet its liability using current assets, excluding inventory. Inventory can be slow moving and hard to convert into cash. Here it's a high, which is good from one point that it can easily cover its current liabilities, but on the other side, it's extremely high, and this might be warning signal, as well as the reason again might be that high cash balance not used properly. Gross margin ratio of 38% means that for every $1 generated, 62 cents goes into the cost of goods sold, while 38 cents remain to cover expenses and taxes. If this ratio is relatively low, the company might consider strategies like purchasing inventory at a lower cost or selling goods at a higher price to improve it, increasing the markup on goods. Our next ratio is called EBITDA margin ratio. But before learning what is EBITDA margin ratio, let's explore one of the key financial metrics in finance called EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. It's a powerful tool used to gain a more detailed view of the operational side of business. It's one of the most popular financial metrics used to assess a company's financial health and widely used in finance decision making. Think of EBITDA as a different lens through which we view companies' profitability performance. You might be looking at the P&L statement on your screen, wondering how EBITDA emerged from these numbers. Well, let's break it down. Remember, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So the formula for EBITDA calculation is right there in its name. First, we need to build our P&L statement and get final numbers. Then we will deduct anything related to interest, tax expenditures, depreciation, and amortization. These are the deductions that EBITDA doesn't include. Let's walk through an example using the numbers on the screen. We start with the final net income, which is the $15,000. Deduct taxes, which is the $6,000. And then deduct also all interest-related incomes and expenses. This step takes us to what's known as operating income, which in this case is $22,000. Now we need to subtract depreciation and amortization. Typically, these are part of operating expenses or OpEx. You should know the exact portion of operating expenditures related to depreciation and amortization. In this example, let's assume that depreciation and amortization together it's $400 out of $2,000. So from the operating income of $22,000, we subtract $400 for depreciation and amortization, leaving us with an EBITDA of $21,600. That's it. If you know structure of your P&L statement and where numbers are sitting, then it's very easy to do this simple arithmetical task. As we wrap up our discussion on EBITDA, you might be wondering, why do we exclude interest, taxes, depreciation, and amortization expenditures from this financial metric? The key reason is that EBITDA is all about understanding the operational performance of business. By excluding these specific elements, we make it easier to compare the operational performance of different companies. Let's break down what each of these components represent. Interest income signifies earnings from investment, while interest expenses are associated with the cost of borrowed money. Tax expenses are influenced by a variety of factors, primarily geographical ones. They can vary widely among companies and jurisdictions, making it difficult to make an apples-to-apples comparison. And depreciation and amortization. These are non-cash expenses that depend on historical investment decisions. They don't reflect current operating performance, but rather past financial choices. It's important to note that in certain scenarios, depreciation and amortizations are added back to the metrics. In such cases, it's referred to as EBIT, not EBITDA. EBITDA serves for various purposes, but in your case, if you are a data professional, it can be particularly useful in BI projects or when you need aggregated data along with EBITDA for further financial modeling and analysis. Along with EBITDA, you can also use EBITDA margin ratio, which is calculated by dividing EBITDA to total revenue. The one with better EBITDA margin figures, and other non-EBITDA metrics is considered to have better operational efficiency and better growth potential compared to another. Both EBITDA and EBITDA margin ratio are indicators that also used to assess the cash profitability of companies together with cash flow or separately. These metrics can be used in many data projects, BI, forecasting, animal detection, and so on. So when you see EBITDA, remember that it's a tool designed to help us better understand a company's core operations by removing the interest, tax, and non-cash expenses such as depreciation and amortization. We will have some example of use of this ratio in our last practical session using artificially created accounting data and Python programming language. Now let's roll up our sleeves since it's a practice part again. We will calculate ratios based on the provided statements. Formulas you already know, so please pause the video and take your time for calculation. Here are the answers displayed on your screen. Hopefully it was not very difficult to calculate them. In summary, ratio analysis can greatly enhance your understanding of the finance domain and stimulate your creativity in data projects, especially in the areas of anomaly detection, forecasting, and BI. If your data analytics project requires more understanding of financial statement analysis and ratio analysis, then I recommend you reconsider continuing your learning with additional resources. There are plenty of books and video courses on this topic for any level. Doesn't matter if you are beginner or advanced. We have reached the end of our session. Hopefully you found this lesson useful. I look forward to seeing you in our next lesson where we will explore SAP ERP and its modules. Thank you for watching.